Hello, Assalamualaikum. My name is Nazhan Shakir bin Abdul Razak and I will present about trade payable. First, trade payable are cash owed by an entity to the supplier of goods and services. Trade payable is classified as a current liability. Example, an entity purchased goods on credit from B and promised to settle the credit on day 30 after the purchase. Solution: there will be a payment of cash to B on day 30. After the purchase, the amount owed is a trade payable which is classified as a current liability in the financial statement. There will be an obligation to pay cash settle the credit on day 30 after the purchase. B has contractual right to retrieve the cash from the entity. Objective of providing information on trade payable. Information on trade payable is useful to the existing and potential investor, lender, and other creditors in helping them make decisions about entity. Initial measurement of trade payable. An entity shall measure trade payable at the fair value plus transaction cost. Example, entity purchased goods amounting to Rm 10,000 from its supplier. The entity agreed to settle the credit on day 15 after the purchase. Solution: trade payable would be recorded as below: debit purchase account, credit trade payable account, paid cash on the day 15, debit trade payable, and credit bank. Presentation of trade payables. Trade payables are presented as an item of current liability in the statement of financial position. As we can see on example I have attached, trade and other payables are under current liabilities.
Assalamualaikum, saya Muhammad Haziq. Today I want to present about provision, contingent liabilities and contingent asset. 5.6.1 Objective of disclosing provision and contingencies to users. Information on provision and contingencies should be disclosed to the user's financial statement to assist them in understanding the nature, timing, and amount of the provision and contingencies. Users need to know when obligations are due so that they can plan and take appropriate action. Second is the objective of the standard is to ensure that appropriate recognition criteria and measurement bases are applied to provision and contingent liabilities, and that sufficient information is disclosed in the notes to the financial statement to enable users to understand their nature, timing, and amount. The objectives of this standard is also to lay down appropriate accounting for contingent asset. Next is 5.7 provision. 5.7.1 Definition of provision. Provision of liabilities of uncertain timing or amount or both in MFRS 197.10. A provision can be classified as a liability because it has all the characteristics of liability, which are: A. A past of obligating event has occurred. B. The entity has a present obligation. And C. There is a further outflow of benefit. So here you can see the item description in the statement of financial institution and the reason. 5.72 is initial recognition of provision. First, an entity has a present obligation, legal or constructive, as a result of a past event. Second, it is probable that an outflow of resource embodying economic benefit will be required to settle the obligation. C. A reliable estimate can be made of the amount of the obligation. So the first item is lawsuit in which the outflow of resource is not probable. Description in the statement of financial institution, not a liability. So the reason is there is no present obligation as the outflow of resource is not probable. Second is lawsuit in which the outflow of resource is probable. Description in statement of financial institution. liability and shown under current liabilities or non-current liabilities. Reason, there is a present obligation as the outflow of resource is probable. Third, warranty to customer, liability and shown under current liability. The reason, there is a present obligation as the outflow of resource is probable. Fourth, contractual bonus to employees, a liability and it is shown under current liability. There is a description in the statement of financial institution. The reason is there is a present obligation as the outflow of the resource is probable, same as previous. So the last is future operating loss. Description in statement of institution, financial institution, not a liability. Probable further outflow means that the event is more likely than not to occurrence. The probability that the event will occur is greater than the probability it will not. Reliable amount estimation is since the nature of a provision is uncertain in terms of timing or amount about an entity has estimated the obligation amount reliably. For example, an employer at Focus I Berhad has suffered a serious injury while operating laboratory equipment at one of the entity outlets. The employee has filed a lawsuit against Focus I Berhad. Based on the evidence of the case, lawyer for Focus I Berhad believe that they will not lose the case. Is the probable further outflow of resource? The answer is Focus I Berhad has a present obligation. The injury occur at its outlet arising from a past event. The injury led the filing of the lawsuit. Using the expected value approach, Focus I Berhad recognized a provision for repairs of Rm 70,000. The journal entries to record the provision will be as follows. Particulars, repairs expenses at debit and provision for repairs at credit. Next, 5.7.3 Measurement of provision. The amount recognized as a provision shall be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. An entity needs to make a reliable estimate of the obligation amount. The best estimate of the expenditure is the amount that an entity would rationally pay to settle the present obligation at the end of the reporting period. The entity has to estimate the provision based on its previous experience of similar transactions and report from independent experts. If a provision involves a large population of items, the obligation amount is estimated using expected value approach to determine the probability with outcome. Factors that may affect the amount of provision. First, best estimate. The amount recognized as a provision must be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. Second, risk and uncertainties. The risks and uncertainties that inevitably surround many events and circumstances should be taken into account in reaching the best estimate of a provision. Third, present value, where the effect of the time value of money is materials, the amount of provision shall be present value of the expenditure expected to be required to settle the obligation. Next, future events. Future events that may affect the amount required to settle an obligation should be reflected in the amount of a provision where there is sufficient objective evidence that will occur. Last, expected disposal of asset. Gains from the expected disposal of asset is not considered in estimating the amount of a provision. 5.7.4 Presentation of provision in the financial statement. Provisions are reported either as current or non-current liabilities depending on the date of expected payment. If the provision is expected to be settled during 12 months from the reporting date, it is classified as non-current liabilities. Examples: for 2019, Focus Ain Berhad has a provision for repay of Rm 70,000 which is expected to be settled within 12 months from the reporting date. At the same time, Focus I Berhad has a provision for obligation of Rm 600,000 which is expected to be settled in 2 years' time. Statement of financial position as at 21 December 2019. Non-current liabilities provision for litigations, current liability provision for repairs. For each class of provision, an entity must disclose A. The carrying amount at the beginning and at the end of the period. The additional provision made in the period, the amounts used during the period, the unused amount reversed during the period. An entity must also disclose A. The nature of the obligation and the expected timing of the outflow of economic benefit. An indication an indication of uncertainty about the amount or timing of the outflow. C. The amount of any expected reimbursement.
Bismillahirrahmanirrahim. I'm Muhammad Nur Huzaimi will be continue with 5.8 contingent liabilities. Based on MFRS 137, contingent liabilities is defined possible obligation that arise from past event and where existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future event not within the control of the entity. Contingent liabilities are present obligation that arise from past event but is not recognized because it is not probable that an outflow of resources embodying economic benefit will be required to settle the obligation. The amount of the obligation cannot be measured sufficient reliability. A contingent liability is different from a liability. For example, contingent liability include a lawsuit in which it is possible that an entity will lose and guarantee relate to collectibility of a trade receivable. Possible obligation. If the obligation is possible, the company has no present obligation that arise from a past event. Therefore, it cannot be classified as a liability, even though the company has a present obligation. The definition of a liability is not made if the outflow of resources is not probable or and the amount cannot be measured reliably. Therefore, the item cannot be classified as a liability. Now we're going to continue with 5.8.2 Recognition of Contingent Liabilities. We should not recognize a contingent liability unless the possibility of an outflow of resources embodying economic benefit is remote and entity should a contingent liability at the reporting date. A brief description of the nature of contingent liabilities needs to be provided and were practicable. First, an estimate of its financial effect. Second, an indication of uncertainties relating to the amount or timing of any outflow. And last, the possibility of reimbursement. 5.8.3 is referred to disclosure of contingent liability. Note 2, significant accounting policy. 2.2, summary of significant accounting policies. The first is contingencies. A contingent liability or asset is a possible obligation or asset that arises from past event or non-occurrence of uncertain future event not wholly within the control of the group. Contingent liabilities and assets are not recognized in the consolidated statement of financial position of the group. For the example, Focus I Berhad is taking legal action against Borneo Optic Berhad for failing to deliver on contract for its product. The lawsuit is in the final appeal. The legal advice is that it's probable that they will win the case and will be awarded 600,000. It is possible for Focus Eye Berhad to recognize this item as an asset. So why? The answer that this is a contingent asset. A contingent asset cannot be recognized as an asset even though the gain is probable and realized by estimate. The gain should only be recognized when it is certain or virtually certain. It is disclosed, but care should taken to avoid misleading information regarding the likelihood of the gain. Now, we're going to continue with 5.9, refer to contingent assets. Contingent assets, as defined, is possible asset that arise from the past event and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future event not wholly within the control of an entity. The definition is based on MFRS 137.110. For example, contingent assets include a claim that an entity is pursuing through legal processes where the outcome is uncertain, possible receipt of monies and from donation, bonus or gift. How to recognize the contingent asset? An entity should not recognize a contingent asset. A contingent asset should be disclosed in the director's report where an inflow of economic benefit is probable. The disclosure include the nature of the contingent asset and where practicable the estimate financial effect of the asset. When the realization of income is certain or visual certain, then the related asset is not a contingent asset and is recognized as an asset is appropriate. So that's all from me and thank you. Assalamualaikum.